Okay, here we are with part 2 of chapter 2. We're going to practice using dead curls or mnemonic dead curls to help us do some T accounts and then journal entries. So I like to teach where you do the T accounts first and then the journal entries. Some textbooks teach you to do the journal entry and then the T account. Sometimes I don't know when transactions get more complex. I don't know my debits right away. I know my credits. So when I map it out for planning, I like to do my T accounts. And then that way I will have all my accounts figured out and then I can plug them on the general journal. And yeah, you'll see what I mean. When you're doing these journal entries here, you do want to record. You have to record debits first and then credits. And so you'll see as we go through some practice ones, why I like to do the T accounts first then. So let's drag over another Word document here. So as we get started here, and let's actually write out our dead curls for us, or mnemonic. So we have it written out there for practice as we go through some T accounts. So we have debit, we have credit for the right side, and then we have E, A, D, and then we have curls missing the R, but that's okay. And then E is for expense, and then A is for assets, then D is for dividends. That's D there, it's sloppy. And revenue, and then liabilities. And then we have stock, which is our common stock. All right, and this sheet, this mnemonic dead curls, tells us what's happening when the count is increasing, or its normal balance. When it's increasing, that's its normal balance, that particular account. If the count is decreasing, it's the opposite side, not too hard. So we got our cheat here to help us out. And so let's go ahead and look at the first journal entry transaction. So we see here that on November 1st, Archer Spy Services received 30,000 cash from S. Archer, and the business issued stock to him. Okay, so we have two accounts affected. We have cash, and then we have common stock. The business, Archer Spy Services, got 30,000 in cash, and then the business also issued stock. So the business needs to reflect that now they have stock issued out, so they're going to increase the stock account. All right, so they got 30,000 in cash, so we'll increase our T account. Every account has a T account, so cash will have one. He'll probably have a lot going on, so we'll just leave him up there as we go through practice. And then we have common stock. All right, it was $30,000 that the company got. It's cash as an asset, so when I look over here, I can see when an asset goes up, it's the debit side, so it's on the left side. So I'll plug in 30,000 on the left side. And then I can see also here that when stock goes up, it is on the right side, credit side. So stock is going to increase by 30,000 because I want to keep track of the balance of that account as well. So that stock account is increasing and it will have 30,000 now sitting in that account. All right, so I need to do my journal entry. I record debits first. So we can see here cash has a debit, and so I will go first, and then our common stock for the credit. So let's go ahead and move that out of my way, and let's get typing here. Let's do our date. Let's be a proper. And so we have cash. We know that that was the debit for 30,000. This is way neater than having me write with the pen, because you see how bad my handwriting is. So it's better that I type it this way. Perfect. And then you usually write a descriptions. When you go through homework in later chapters, they'll probably not require you to write descriptions anymore. Most likely you're using software, and so you'll get a drop down for description. So choose the one that's best. But in this case, something like we issued common stock. Okay, so that's in the last line, the description. So we have one debit, one credit, we balance, we're happy. Debits equal credits. All right, we can move on. Let's look at the next transaction. In this transaction, they used that 30,000 cash, right? They used 20,000 of cash to pay for land. All right, so we got land. The business got land that's worth 20,000, and they used 20,000 in cash. So let's go ahead and look at our T accounts again. Let's make another T account. So we used 20,000 in land, so in cash. So we can decrease our cash account. Well, cash is an asset, and when it goes up on the debit side, right? We did that with the 30,000. So in this case, it is going to decrease, so it's the opposite side, so it'll be the credit side. All right, there's my decrease. And we need to make another T account for land. You don't want to forget land. And so you can see here, I already went in the other direction. I have a credit for 20,000, but I just told you that when we record journal entries, we always record the debits first. So I can't write cash first on my journal entry. That's a credit. I need a debit. Oh, well, now we have land. We have $20,000 worth of land. Land is an asset, and when land increases, it increases on the left side, debit side. Perfect. So now I have a debit for land and a credit for cash. So let's go ahead and write that out. Perfect. And we could say something like we paid cash for land, purchased land with cash, something like that. So let's just do this. So that's our description. All right, let's go to the next one. We purchase office supplies on account. Okay, so no cash was used to pay for the office supplies. The business Archer Spy Services said, put it on my account, I'll pay it later, hopefully in 30 or 60 days. So they owe it. They have a payable. All right. So let's start with office supplies. They got office supplies for $500 worth. So we do another T account. So you see, I'm going to have a lot of T accounts going here. I'll start erasing some to clean up here, but we have room. Office supplies. That's an asset. Okay, when an asset increases, it increases on the left side. So we have office supplies for 500 bucks on the debit side. So that's good. And it said it was on account. So we didn't have cash go out. Instead, they put it on my account. I'll pay it later. So we have a liability. And so that liability count is called accounts payable. All right, and that liability count, when it increases, I already circled it, but it increases on the right side, which is the credit side. So that's why I'm going to do $500 on the credit side. So I have one debit for office supplies at $500 and one credit for accounts payable for $500. So you can see what's going on here. It's not too bad. So that's November 3rd. We got a lot of transactions to do. Oh, geez. We might break this out in separate videos just so you have little pieces. If you get the idea of it, then you're good type of thing. So let's do office supplies. 500. And then we would say purchase office supplies on account. Perfect. All right, we're in balance. We're happy. We got all our accounts that were affected. Let's do transaction 4. So we have on November 8th, Archer Spy Services collected cash of $5,500 for services that the business earned by providing spy services for clients. So the clients, they provided, so the Archer Spy Services did their spy services already for the clients. Cool. So that means they earned it. So they get to record their revenue, and the customer gave them cash right away. Nice. So we know that we have 2 accounts again, cash and then services. So let's go ahead and let's get rid of some of these ones here because we're running out of space. So let's quickly erase them. We'll leave cash there because cash is going to keep having stuff happen to them. So we'll just leave that one there. All right. So we did some SPY services. So we get to say service revenue. That's an R. That's awful. Service revenue. And so when revenue increases, now we get to record some revenue, right? So that account's going to go up. When it goes up, it's on the right side, the credit side. And that was for 5,500. All right, and they got cash. They got cash right away from that customer. Awesome. So cash asset increases on the left side, debit side. So there we go. We got a debit for cash and a credit for service revenue. Going quick now. And you can see that I was stressing that we get to, you'll learn later in later chapters that there's some rules and you don't get to record your revenue until it's actually earned. And so that's why we're recording our revenue, because the SPY services were provided, so they were earned in this case. So something like performed services and received cash. Something like that. You'll get a drop down, so it'll be easier that way. All right, so next transaction we have is they perform services for clients for which the clients will pay later. The business earned $3,000 of revenue on account. So they were very nice. They helped you out here. They're telling you did not get cash yet. So the customer said, put it on my account, I'll pay you later. So we're going to receive cash from the clients, hopefully in 30 or 60 days, but we didn't get the cash yet. It'll become cash soon. So it's an asset and it's called accounts receivable instead. So we're going to record the cash that we're going to receive soon as an account called accounts receivable. That's what it is when it says on account. They did perform the services, so they do get to record revenue, so we're good there. So let's go ahead and bring over that Word document, that other one, so we can record this. So we have another account that I told you. It's not cash yet, but it'll become cash soon, and that's accounts receivable. Oh man, there's my eye. So sloppy. That's why I'm typing in another one. And so accounts receivable is an asset. When it increases on the left side, the debit side. So we have 3,000 there. And then we also, I said they earned the revenue. They provided the services, so they get to record their additional revenue. So we can see as those accounts, you're going to have T accounts for all the different accounts, and you're going to keep building on them. So you can see service revenue now has 2 transactions within, and the T account for cash has 3 within it. So that you'll keep track of them, and you'll see that in your homework as well. So we're going to record our debit for accounts receivable and our credit for service revenue. So let's go ahead and do that. We have November. Oh, what happened here? We have November 10th. And we had a not to cash because we are going to receive it. The customer owes it to us for $3,000. And then we did earn it, so we get to record service revenue for $3,000. All right, cool. Next one we have is payment of expenses with cash. So they paid the following cash expenses on November 15th. They have, there's a compound entry. So we can see there's more than now. I even gave you an extra space as well. You can see there's more than more than 2 accounts affected. We're going to have 3. We have 2 expense accounts and then also cash, because cash was paid out. All right, we can handle that. We can handle that. So we have two expense accounts that we now need to record. So we'll make a T account for one of them, which was rent expense. And then the other one was salaries expense. Rent, it said it was for $2,000. And we know expenses, when they increase, that account is going to be increased now. We didn't have anything in that account before. Now we do. We need to keep track of all our rent expenses. And so we're increasing that rent expense account by $2,000 now that we want to keep track of. And salaries is increasing by $1,200. All right. So we have two debits, $2,000 and $1,200. We need a credit. We're not balanced yet. Okay, that was cash. Cash was being paid. So that was for a total of $2,000 and $1,200. So that is $3,200. So we can see how we're going with these T accounts here, and so you're probably catching on. So let's go ahead and record this. We have two debits we're going to record, and then a credit for cash for $3,200. And this was on November 15th. We have rent expense, and that was for $2,000. And then we have salaries expense for $1,200, and then we paid out cash for the total. That debit and that debit added up. Okay, that's the cash. That's the total cash I paid out, $3,200. And if we were still, I could see I got lazy on the one above and I didn't write my description already. Paid cash expenses for this one, and then this one would have been perform services on account, right? We didn't get cash yet. I think you're getting the idea for those descriptions, so I probably can skip them for the remaining ones. Let's do a couple more for this video, and then we'll do another part video since it's a bunch in a video, and I can see that we're already at 17 minutes. That way you can do it in parts. Okay, so transaction 7, payment on account. Oh, they were nice. They told you it was accounts payable, but we know when it was on account, if it's wasn't a longer term type item or a mortgage or bank loan or something like that, longer term one with interest tied to it, that would have been notes payable. Otherwise, we're going to go with accounts payable. So Archer Spy Services paid $300 on accounts payable created in transaction 3. So we can see here that we made a payment on our account payable from transaction 3. So let's go back up and look at transaction 3. And here we go. Remember that accounts payable that we said that Archer Spy Services had put on my account, I'll pay it later. We had increased our accounts payable for a credit of $500. And so now we're making a payment on it, right? We're said we'll pay it later, and now we're paying, well, we're not paying all $500, we're paying $300. So we're going to decrease this accounts payable, and what are we paying them with? Cash, right? By cash. So cash is also decreasing. So we have two accounts decreasing, but don't worry, we're going to, with a debit and credit, we'll do our T account. So we have accounts payable decreasing by $300, and then we have cash going out, decreasing by $300. So let's go ahead and bring over our Word document, and I'm going to set it up for you. So I'll pause it so we can have a nice clean slate there. Okay, there we go. Nice clean slate. Remember, we had previously a transaction of accounts payable where it was sitting there for $500, and now we're making a payment on that account, that accounts payable. So we're going to make a payment for $300. So we're going to decrease cash by $300. Cash is going goodbye, and so cash is an asset. When an asset decreases, it's the opposite side. So instead of debit, it's a credit. So that's why we got a credit for $300 there. And then also when a liability, normally when a liability increases or its normal balance, that's a credit. So that's why that 500 was on the credit side, the right side. And now we're paying down that liability, so we want to reflect that. So $300 will be a debit, the opposite side. All right, so there we go. So if we're saying, hey, what's our balance for accounts payable? Well, it would be 500 minus the 300. It's 200 left due, right? Perfect. So this is our journal entry anyway. I went ahead on this, but we can see we have a debit for accounts payable and a credit for cash. So let's go ahead and do that. All right, November 21. And we have debits go first. So that's why we're writing the accounts payable first for 300 bucks. And then goodbye cash because we're paying what we owe. And there you go. There's a credit for cash. So we would say something like paid on account. I'll write it. Why not? Paid on account. All right. Or maybe paid at cash on account. All right, one more, and then we'll pause this video and make that be part one. So collection on account, accounts receivable. Oh, okay. So now they were nice. They told us what account it was, but we're going to go look at transaction 5. So we'll figure that out. So Archer Spy Services collected 2,000 cash from a client in transaction 5. So let's go back up to transaction 5. And in transaction 5 here, you can see that the customer had said, put in my account, I'll pay you later. So we didn't debit cash because we didn't get cash from the customer. They owe it. They owe us. So we're going to receive, Archer Spy Services is going to receive cash soon, just not yet. And so that's why we debited accounts receivable. Now that customer's paying us. Did they pay us all $3,000? I forgot. Let's see. No, they only paid us $2,000. So they had owed us $3,000. We were going to receive $3,000 from them, but we already received right now $2,000 from them. We're not going to record another service revenue because we already recorded that when we provided the services, when they were earned. So we're not going to record service revenue in our transaction. What did we receive from them? We received cash. So we get to record that we got cash. And then we're going to decrease this accounts receivable account by $2,000 because we're not going to be looking for $2,000 anymore. All right, so let's go ahead and set up that. So let's draw another T account for accounts receivable. And if you were writing all your T accounts, you would have already had an accounts receivable. I don't remember what they had all going on, but we know for sure from transaction 5 that there was $3,000 debit. So I'm just going to put that $3,000 debit there so we have it because we know that's what's in relation. So in our transaction that we're recording, now they're saying the customer's paying it. So we're getting cash from the customer. Cool. We're getting $2,000. So cash goes up by $2,000. So we can see that that is our debit. And then now we're not going to look for $2,000 from that customer anymore. So we're going to decrease accounts receivable. Accounts receivable is an asset. And when an asset increases, it's on the debit side. When it decreases, it's on the right side, which is a credit. So you can see there, that's why we have that. That's the other part of our transaction. I don't know what happened there. It duplicate. That's okay. This is our last one that we're doing. So 3 minus 2. Okay, our accounts receivable balance is 1,000. If they were to say how much is left that they owe us, $1,000 bucks. But we got our transaction, we got our journal entry one, we got the 2,000 for a debit, and then the accounts receivable for a credit. So let's go ahead and record those two that I circled. Remember, debits first, so we got cash for 2,000 bucks. And then we're saying, okay, we're not going to look for from that customer $2,000, so we got to decrease our accounts receivable. Perfect. And last one, received cash on account. All right, it's Grammarly is giving me problems here, but we know what I'm trying to say there. Okay, so this is it for our first part. We'll do another part where I'll go through, but I think you got the idea, so you're probably good at this point. But we're gonna do the next part where I'll go through the remaining 17 transactions in the next part video.